If intelligence alone created profitable traders, the market would be dominated by scientists, engineers, and professors. But it isn't. Some of the most educated people in the world quietly lose money in the markets every year. Meanwhile, some traders with average education and very simple strategies pull consistent profits. So something doesn't add up, because trading looks intellectual. Charts, data, analysis, probability. It feels like a thinking game. But the truth is uncomfortable. Trading is not a test of how well you think. It's a test of how well you behave. The market doesn't reward intelligence. It rewards emotional stability. And that difference is where most traders fail. Most people enter trading believing one thing: if I learn enough, I'll win. So they study. Technical analysis, smart money concepts, indicators, macroeconomics, order flow, backtesting, strategy optimization. They treat trading like an exam, study more, arrow score higher. But trading isn't school. There is no final test, no correct answer, no guaranteed result. You can do everything right and still lose. And that breaks the mental model of intelligent people, because their whole life taught them correct action equals reward. Trading teaches correct action equals probability. Sometimes yes, sometimes no. Your brain hates that. Human psychology wasn't built for markets. Your brain evolved to avoid danger, seek certainty, protect resources, reduce discomfort. Trading forces the opposite. You must accept risk, live with uncertainty, lose money, calmly delay gratification. To your brain, that feels unnatural. A loss feels like danger. Uncertainty feels like threat. Waiting feels like wasted time. So your brain tries to protect you. It tells you, move the stop, close early, double to make it back, skip this trade, take this one, it looks good. And suddenly you're not trading a system, you're trading your emotions. Let me tell you about Daniel. Daniel had a PhD in engineering, extremely analytical, loved logic and precision. When Daniel started trading, he approached it scientifically. He collected historical data, tested multiple systems, built models, calculated risk metrics, optimized entries. His spreadsheets were beautiful. On simulation, his system worked. Live trading, it fell apart. Not because the strategy failed, because Daniel couldn't execute it. He'd take profits early because locking gains is logical. He'd widen stops because volatility needs room. He'd skip trades because market context changed. Every decision sounded reasonable, but collectively they destroyed his edge. Daniel wasn't trading his system. He was trading his intelligence, and intelligence kept interfering. Smart people fall into a unique trap. They trust their thinking more than their rules. They believe, if I just analyze deeper, I can avoid losses. So they add more indicators, create filters, wait for confirmation, overanalyze setups. But here's the paradox. The more decisions required, the more emotions can interfere. Complexity creates doubt. Doubt creates hesitation. Hesitation destroys consistency. And consistency is where profits live. Many intelligent traders treat markets like puzzles. They try to decode it, master it, outsmart it. But markets are not puzzles. They are probability environments. A puzzle has one correct solution. Probability has many outcomes. You can't solve probability. You can only manage it. Trying to figure out the market is like trying to predict every coin toss. Even with an edge, you still get streaks of losses, and streaks are where emotions attack. A losing streak does strange things to the mind. After 3 to 4 losses, confidence drops, doubt rises, fear creeps in. Suddenly, valid setups feel risky. Normal trades feel dangerous. You hesitate, then the next trade wins, but you skipped it. Now frustration appears, and frustration leads to revenge trading. Not because you're irrational, because you're human. Your brain wants emotional relief, not statistical discipline. Smart people often attach identity to correctness. Being right feels like competence. Being wrong feels like failure. But trading guarantees being wrong often. Even great traders lose 40 to 60% of trades. If every loss hurts your ego, you'll subconsciously avoid them. You'll move stops, hold losers, hope for reversals. Not to save money, but to save pride. The market punishes pride quickly. Now contrast that with Marcus. Marcus isn't flashy, no finance degree, no complex system. He trades one setup, one time frame, fixed risk. He doesn't predict, he executes. Loss? He shrugs. Win? He logs it. No drama, no excitement, no storytelling, just repetition. Marcus treats trading like brushing teeth. Routine, boring, automatic, and boring is profitable. Most traders live in emotional noise. They check P&L constantly. They feel every tick. They celebrate wins. They regret losses. This roller coaster exhausts discipline because discipline needs calm, and stimulation kills calm. If your mood changes with your chart, your emotions are driving, not your system. Trading exposes impatience, ego, fear, greed, need for control, desire for validation. You meet parts of yourself you didn't know existed. Some people quit here because self-confrontation is uncomfortable. Others grow, and those who grow learn that trading mastery is self-mastery. Professionals don't chase certainty. They accept, "I don't know what happens next." That sentence is freedom, because once you accept uncertainty, you stop forcing outcomes. You let probability work. You become neutral, and neutrality is a trader's superpower. Overtrading isn't greed, it's discomfort. Doing nothing feels unproductive. Waiting feels lazy. So traders create action to feel in control. But markets pay for patience, not activity. A sniper wins by taking fewer shots, not more. The shift happens when you stop asking, "How do I predict better?" and start asking, "How do I execute better?" Prediction feeds ego. Execution builds accounts. Here's the truth. Most don't want to hear. The market doesn't care how educated you are, how smart you are, how hard you studied. It only cares about one thing. Can you follow your rules when emotions get loud? Because emotions will get loud. They always do when money is involved. So the real question is not, can I outsmart the market? It's, can I stay calm inside it? Because in trading, the person you must beat isn't other traders. It's yourself. Most traders think their biggest enemy is the market. Volatility, news, manipulation, smart money, algorithms. But none of those wake up inside your head and tell you to break your rules. Your brain does, and unless you understand how your mind reacts to money, you will keep self-sabotaging without realizing it. Because trading isn't just financial, it's neurological. Every trade you take isn't just a financial decision, it's a chemical event in your brain. When you enter a trade, your brain releases dopamine. Dopamine is the anticipation chemical, not happiness. Anticipation, it's the same chemical triggered by gambling, social media, video games, notifications, casinos. Your brain loves uncertainty with possible reward. That's trading. Every open position becomes a mini casino inside your head. You're not just trading markets, you're trading neurochemistry. Have you ever checked charts when you didn't need to, opened your platform out of habit? Felt the urge to see what's happening? That's not discipline failing. That's dopamine conditioning. Random rewards create the strongest habits. If trading paid you every time, it wouldn't be addictive. But because rewards are unpredictable, your brain keeps checking. Just like pulling a slot machine. Most traders don't realize they're reinforcing addiction loops. They think they're analyzing, but they're stimulating. A winning trade feels amazing. Confidence rises, energy spikes, you feel sharp. But here's the danger. A big win can be more dangerous than a big loss, because wins create overconfidence. Your brain says, I figured it out. I'm in sync with the market. I should size up. That's not logic. That's dopamine talking. The market doesn't reward excitement. It punishes it. Losses trigger a different system. Cortisol, the stress hormone. Your body reacts to losses like threats. Even small losses can feel big because your brain treats money as survival resource. This is ancient wiring. Thousands of years ago, losing resources could mean death. Your brain still reacts that way. So when you take a loss, heart rate rises, stress increases, urgency appears, and urgency kills discipline. Revenge trading isn't about greed. It's about emotional repair. Your brain wants relief from the discomfort of loss. Winning back money feels like emotional reset. So you take trades not because they're good, but because they promise relief. That's not strategy, that's self-medication. And the market charges heavily for emotional trades. Many traders secretly trade for validation. A winning trade feels like proof. I'm smart. I understand markets. I'm improving. A losing trade feels like I failed. I misread. I'm not good enough. So they try to avoid being wrong. But trading requires being wrong often. If you emotionally resist losses, you'll sabotage exits. You'll hope instead of act. Hope is expensive in markets. FOMO is powerful because it attacks imagination. You don't fear losing money. You fear missing opportunity. You imagine, that could have been my trade. I knew it would move. I should have entered. So next time, you enter early. Without confirmation, without patience, and often without edge. FOMO turns observers into impulsive participants. Humans crave control. Trading removes it. You control? Entry risk. Size rules. You don't control. Outcome movement. Timing volatility. Many traders secretly try to control outcomes. They move stops, close early, re-enter quickly. They're trying to control uncertainty. But control in trading comes from process, not prediction. Patience isn't passive, it's active restraint. Your brain prefers action because action feels productive. Waiting feels like inaction. Inaction feels like wasted time. But in trading, waiting is a position. No trade is a valid trade. Professionals know this. Amateurs feel guilty doing nothing, so they manufacture trades. Outside trading, intuition can help. In markets, intuition is usually memory plus emotion. Your gut remembers last win, last loss, last regret. It's biased. Systems beat intuition because systems don't feel. Your gut has no statistics. Your system does. Ego shows up quietly. It says, I see something others don't. This trade is obvious. I'll bend rules just this once. Ego wants to feel superior, but the market humbles ego without warning. Every blown account has ego somewhere in the story. Social media made trading harder. You see, big wins, payouts, perfect entries, fast profits. You don't see drawdowns, loss streaks. Emotional struggles. Comparison creates pressure. Pressure creates forcing. Forcing creates losses. Your journey is statistical, not social. Excitement and profitability rarely live together. Excitement seeks stimulation. Profit seeks stability. A disciplined trader's day is calm, predictable, routine, no adrenaline, no drama. That's why many quit. They wanted thrill, not process. A professional trader doesn't aim to feel good daily. They aim to execute well. They measure success by rule adherence, not P and L. Because good process leads to good outcomes over time. Amateurs judge daily. Professionals judge statistically. The real transformation happens when you stop seeing yourself as a person trying to win trades and start seeing yourself as a risk manager executing a system. That shift removes ego, removes drama, removes pressure. You become an operator, not a gambler. Strong traders reset daily. Yesterday's trades mean nothing today. No revenge, no pride, no carryover emotion. Each day is independent, like flipping a weighted coin. Memory can distort discipline if you carry it emotionally. Ask yourself honestly, if someone forced you to follow your rules exactly for 100 trades, no deviation, no impulse, no exceptions, would you be profitable? If yes, your problem isn't strategy, it's self-control. Your brain is not your enemy. It's just not designed for trading. It wants safety, certainty, comfort. Trading demands uncertainty, risk, patience. The traders who succeed don't eliminate emotion. They design systems that protect them from it. Because willpower fades, but structure lasts. And in trading, structure beats motivation every time. Most traders don't fail because they lack knowledge. They fail because their discipline collapses under pressure. It's easy to follow rules when nothing is at stake. It's hard when real money is on the line. Pressure changes behavior. Pressure exposes truth. And in trading, pressure is constant. So the question becomes, how do you build discipline that survives pressure? Not motivation, not hype, not willpower, real discipline. Many traders rely on willpower. They say, today I'll be disciplined. I won't overtrade anymore. I'll stick to my plan. But willpower is unreliable. It weakens when you're stressed, you're tired, you've lost money, you've won big, you're emotional, which describes most trading days. Willpower is a battery. It drains. Professionals don't rely on batteries. They build systems. Real discipline comes from structure. Structure removes choice. Fewer choices equals fewer emotional errors. Think about pilots. They use checklists for things they already know. Why? Because pressure makes humans forget. Emotion creates mistakes. Trading should be the same. Rules written, steps fixed, process repeatable, not flexible, not negotiable. Every decision during trading is a chance for emotion to interfere. So strong traders reduce decisions. They predefine what to trade, when to trade, how much to risk, when to stop, when to walk away before the market opens. During market hours, they execute, not think. Thinking under pressure is emotional thinking. Disciplined traders prepare before the game starts. A simple pre-market routine. Review levels. Mark setups. Define risk. Set daily limits. Mentally rehearse losses. Yes, rehearse losses, because losses are normal. If you only imagine wins, you'll emotionally reject losses. Preparation creates calm. Calm creates discipline. Daily limits protect psychology. A daily loss limit is not about money, it's about emotional capital. After a certain drawdown, decision quality drops. So professionals stop, not because they must, because they know themselves. Stopping early often saves more than pushing. Many disciplined traders use a simple rule. 2 losses in a row implies step away. Not forever, just reset. Because 2 losses can trigger tilt. Tilt is when emotion drives decisions, and tilt rarely announces itself. It feels like urgency, like determination, like getting it back. But it's emotional trading. Your environment shapes your behavior. If your phone shows P and L constantly, you'll think emotionally. If Twitter is open, you'll compare. If Discord chats are active, you'll second guess. Remove noise, reduce inputs, simplify screens. Clean environment equals cleaner mind. Profitable traders act like operators, not predictors, not heroes, not geniuses. Operators follow process. A robot doesn't. Feel fear. Feel pride. Chase losses, celebrate wins. You don't need to be emotionless. You need to act as if rules are law. Execution over opinion. Money carries emotion. Bills, security, status, freedom. So when you trade money, you trade meaning. That's heavy. Professionals reduce meaning by risking small percentages. They think in R, not dollars. Not, I lost $200, but I lost 1 R. This reframes emotion into statistics. Statistics are calm. Dollars are emotional. Weak traders think, this trade matters. Strong traders think, this sample size matters. One trade is noise. 50 trades show edge. Hundreds show consistency. Zooming out reduces pressure. Pressure shrinks when you think long-term. The strongest discipline comes from identity. Instead of saying, I want to be disciplined, say, I am a rule-based trader. Identity drives behavior. If you see yourself as a professional, you'll act like one. If you see yourself as a gambler, you'll act like one. Your actions follow identity. Most traders only journal results. Professionals journal behavior. They track. Did I follow rules? Did I hesitate? Did I feel emotional? Did I force trades? Because behavior predicts outcomes. Fixed behavior, profits follow. Boring routines create stability. Same setup, same process, same rules. Repetition builds trust. Trust builds confidence. Confidence reduces emotion. Excitement destabilizes. Boredom stabilizes. In trading, boring is powerful. A simple exercise. Before each trade, say, this trade means nothing. Not negatively, statistically. It's one event in a large series. This reduces emotional weight. Less weight equals clearer decisions. Here's a quiet truth. Most profitable traders are not emotionally intense. They're calm people. Calm doesn't mean passive. It means stable. Stability allows consistency. Consistency builds equity curves. Wild emotions build roller coasters. At first, discipline feels forced. Later, it feels normal. Eventually, breaking rules feels uncomfortable. That's when growth happens. When discipline becomes your default. You don't need superhuman control. You need protective structure. Because the goal isn't to remove emotion, it's to prevent emotion from making decisions. Discipline isn't built in big moments. It's built in small, boring, repeated actions. And over time, those small actions separate gamblers from professionals. Most people enter trading to make money. Few realize trading will first change them. Because if you stay in this game long enough, you don't just build a strategy, you build a different mind. The market slowly reshapes. Your patience, your ego, your emotional control, your relationship with risk, your relationship with uncertainty. And in the end, the biggest profit isn't financial, it's psychological. Almost every trader moves through stages, not by choice, by experience. This is the beginning. Charts are fascinating. Profits look easy. Freedom feels close. You believe, this can change my life quickly. You trade often, you chase moves, you imagine the future. This stage is fueled by hope, and hope is powerful, but dangerous. Reality appears, losses stack, strategies fail, confidence cracks, you start questioning. The market your system. Mentors yourself. Many quit here, not because they can't succeed, but because expectations collapse. This stage is painful, but necessary. It breaks illusions. You notice a pattern. Losses don't come from strategy alone. They come from behavior. You see yourself. Overtrading, breaking rules. Forcing setups. Acting emotionally. This is a turning point. Some accept it, some deny it. Acceptance leads forward. Denial leads in circles. Now trading becomes internal. You work on patience, risk control, emotional reactions, discipline systems. You trade smaller, you think longer term, you respect probability. This stage is quieter, less exciting, more serious. Growth happens here. Few reach this stage. Here, trading feels normal. No rush, no fear spikes, no revenge trades. Wins don't inflate ego. Losses don't crush mood. You trust your process. You think in samples. You detach from outcomes. You stop chasing. You start executing. And ironically, this is where consistency begins. Big wins test maturity. A large profit can distort perception. You feel skilled in sync. Confident. Different now. But the market resets everyone. Big wins often lead to oversizing, looser rules, extra trades. Professionals treat big wins like normal trades. No celebration, no lifestyle changes, no emotional spike, just another data point, because protecting mindset is more valuable than celebrating money. Drawdowns are inevitable. Even great traders face them. The difference is response. Weak traders panic change systems, chase recovery. Strong traders reduce size, review data, protect psychology. They don't fight drawdowns emotionally, they manage them logically. A drawdown is feedback, not a verdict. Urgency destroys traders. Feeling behind, feeling late, feeling pressure to make income. Urgency creates forcing. Forcing creates mistakes. The market rewards patience, not timelines. There is no deadline for consistency, only pressure you put on yourself. Many dream of trading full-time. Freedom, no boss, flexible life. But full-time trading is mentally demanding. You face isolation, self-doubt, performance pressure, income variability. It's not easier, it's different. Some thrive, some don't, and maturity is knowing what fits your personality. At first, money feels emotional. Later, it feels numerical. That shift is huge when money becomes risk units. Percentages statistics. It loses emotional grip, and when emotion drops, execution improves. Long-term traders survive. Short-term thrill-seekers burn out. Thinking in years instead of weeks changes everything. You stop rushing. You stop forcing. You stop comparing. Slow consistency beats fast chaos. Real confidence in trading is quiet. It doesn't brag. It doesn't predict. It doesn't boast. It simply says, I'll follow my plan. That's it. No drama, no ego, just process. At some point, a trader stops asking, how much can I make? And starts asking, how well can I execute? That shift changes careers, because focusing on money creates emotion. Focusing on execution creates results. Imagine this. If profits were invisible for 6 months, no P&L shown, no balance updates, only rule following tracked, would you still trade the same way? If not, money is controlling you, and awareness is the first step to freedom. If you stay long enough, trading teaches you patience over impulse, process over prediction, calm over excitement, discipline over intelligence. You become someone who accepts uncertainty, controls risk, stays emotionally steady, thinks in probabilities. These traits extend beyond trading. They change decision-making, business, life. The market never cared how smart you were. It never cared how hard you studied. It only ever asked, can you stay consistent when emotions rise? Can you follow rules when it's uncomfortable? Can you accept uncertainty without panic? Because those who can, last. And those who last, learn. And those who learn, eventually earn. In the end, trading is not you versus the market. It's you versus your impulses, your fears, your ego, your impatience. Master those, and the charts become quieter. Not because markets changed, but because you did. And when that happens, you're no longer chasing the market. You're operating within it. Calm, measured, disciplined. And that is when a trader is born. If this video gave you value, make sure to subscribe. This channel isn't about hype. It's about real trading psychology and long-term growth. New videos every week to sharpen your mindset. Subscribe, and I'll see you in the next one.